So we've seen what's happening in the debt, household debt, corporate debt. When I say corporate debt, I mean, yes, corporate debt, but more of the private sector debt other than the state-owned enterprises. And we've seen how the government debt, in particular local government debt, is adding to this debt pile. Now, all this has to be financed. I mean, debt, yes, you can print debt, but for example, Zimbabwe can print debt, but it's got no fundamental basis upon which that debt has any value, hence the hyperinflation that exists with its economy. So China and obviously the Western economies have some sort of value which they can back that debt with, and China is no exception. So how does China finance its economy? Well, there are three main areas. We've got export revenue coming in from massive trade surplus, for example, with the United States, trade surpluses with the European Union, trade surpluses with the rest of the world, and that's no surprise because there is the Chinese economy, from an economist's point of view, has got huge economies of scale, which means that their cost price per unit is often substantially lower, and because of their economies of scale, they can get their raw materials much cheaper from the poorer countries in the developed world. So their cost basis is in many ways much more fine-tuned than what we have in the more developed world, where our cost basis, especially for labour, is much higher. So export revenue, that's one reason why they're able to export, is because not just because of the subsidisation, as I mentioned before, with the government SOEs, but because they do have those, or have had those advantages, but those advantages have been deteriorating over the past decade as China's economy grows, and then demands and labour grows, and then the cost of labour goes up on that. And we have seen significant shifts of labour by Western companies into India, Vietnam and other areas. So Chinese labour is no longer as cheaply advantageous as it has been. Now, the other way of financing this expansion has been through domestic production, but not all of it, as I've said, has been profitable, because as I pointed out, that the means of production within the Chinese economy, especially for SOEs, is produce the capital irrespective of what profit you have, and then if there is no profit, then you subsidise that from the central government. So that still it has a multiplier effect. Every dollar that you put in, whether from exports coming back from export revenue, or whether from domestic consumption and domestic production, it does have a magnifier effect. And then obviously the big biggie, as I've said, is that debt has been the tinder that has lit the whole fire, basically. So I mean, if the government, say for example, wants a huge complex up in Shenzhen, then boom, they put in several billion, and a major skyscraper's done, and 300 small companies take up office there, selling wares through AliExpress, Alibaba, many of those sort of like online sites, just as an example. So they're the three main areas where this sort of liquidity comes from. But trade, whereas there is to a certain extent more control that the government has on domestic consumption, and also in the production of debt. They do have, and as I said, pointed out earlier, they have much less control over external factors, and this has been directly, if you've been watching just alone the mainstream media, which I don't give much credence to in much of their analysis, but anyway, if you'd have to live under a rock to not know that there's the beginnings of a very serious trade war going on between China and the United States. Now, whereas 200 billion has been affected, and I think it's 10%, if there's nothing agreed in the next month or so from the date of this video, which is more or less almost the middle of February, then these tariffs are going to go up to 25%, and that will have a significant effect on it with another 250 billion. So most of the trade surplus that China has is going to be under some sort of threat, and this is going to directly affect cash flow in the domestic economy. And remember, if Chinese companies aren't necessarily making a profit in the public sector, in the state-operated enterprises, and then we have a massive profit squeeze for those companies that are profitable in the private sector, then we've got a lot of trouble brewing up in servicing those debts in the future. Now, another area of potential lack of control that the Chinese government has is direct foreign investment. And I alluded to this earlier on, basically, because quite simply, Chinese have been thieving intellectual property rights left, right and centre. It's not uncommon for a company to come in, set up a factory in China in one of their industrial zones, and 10 kilometres away or 10 miles away, there's another factory manufacturing the identical same product. And because they don't have any R&D costs, they can sell into their market cheaper. And it's unbeknownst to many people in the West, the Chinese will prefer to buy quality European goods, but quite often they're quite price sensitive as well. So there is a substitution factor. So just because a factory sets up and manufactures its products in China doesn't mean to say that it's going to have an expanded market there. It's still going to have to compete against the knockoffs that it's actually spurned. So the debts, with direct foreign investment falling, export dollars falling, the devaluation of the yuan, even though it's making exports more competitive, the actual value of those exports coming back are reduced. So what we're seeing is that we're going to see debts rise, basically, and what is a major concern even is as these debts start to come home to roost, companies are going to close. And rather like in the West, in terms of, when I say the West, I'm talking about the economies of Europe, the Australia, New Zealand, Canada, United States. As these economies cool and start going into recession, because we're now seeing Italy in recession, Germany's not far off it, Spain is probably not that far off it as well. And with Brexit, there probably will be a recession around the corner. So demand is going to go down. Well, if demand goes down and companies in China start failing, that means unemployment. And unemployment means that the households that have borrowed very severely on more than one house, 2 houses, 3 houses in the shadow banking sector aren't going to be able to service that debt. So even though there has been a phenomenal Chinese property boom, again, the growth of prices has been absolutely exponential. So if we start looking at a property crash, and it's very possible, we will see that probably in the very near future rather than the very distant future. And while it's mentioned that up to 90% of Chinese-owned properties, that doesn't necessarily mean to say that they own them outright. There are still mortgages and loans available to many of them, and new entrants into the market, even though there's a relatively high savings rate, are to some extent exposed to two risks. Number one is the risk of a price fall, and number two is the risk that they're not going to be able to sell their properties when prices do fall, even though there's very steady demand, especially for tier 2, tier 3 cities, because tier 1 cities like Shenzhen and Shanghai, the prices are so high now that the average citizen is just completely priced out. And I'll go into very, very soon what the price per square foot is in many of these places and how ridiculous it's got. So even though we got 90% home ownership, we have 40% of Chinese owning second homes. These homes are all purchased through the shadow banking system, and as I've said before, we have a system. There's a system in China where the culture is such, for example, that men who are single generally have to have a house before they can effectively get married, because there's such competition between men for available women, generally as a result of the one-child policy, because families favoured having male children instead of female children. So there's a definite imbalance, quite an imbalance on that. So we have a high demand, cultural demand. We have 40% of Chinese owning more than one property, because there's not much other choice in terms of investments available. So we have a mirage, for want of a better term, of wealth that's created on property. So it doesn't need much of a property correction to destroy that harmony, as it were, of the Chinese people to the government, as far as contentment goes with what the government's doing with the economy. So as long as housing keeps going up, they're going to be happy. Now, what has occurred is that even though the government, and I've mentioned this before in the part one of this Chinese video series, even though the government is aware of this, they've tried to, sort of cool things down. They're not very good at it, because they know that the housing market in China is directly proportional to the health of the power system within the Chinese Communist Party. And we have this slide from this article from Bloomberg, a Bloomberg opinion piece. And basically what it says is, despite reforms, there's little question, and this is from Bloomberg, as I say, there's little question that Chinese real estate is in bubble territory. Again, Bloomberg, right? From June 2015 to the present day, there's an index called the 100 City Price Index. So obviously it takes an index of the cost per square foot of buildings in 100 of the top cities of China, and it's published by Sufun Holdings Limited. They've basically said that in the last year alone, there's been a 31% increase in the price per square foot, and the price per square foot now is 202 square feet, and that's 38% more than the median price per square foot in the United States. So we've got square footage in China, 38% more than China, but here's the kicker, even according to this article, the per capita income of the United States is 700% greater than in China, and yet China's price per square foot is 38% higher than the US. That, to me, is unsustainable. So what we're seeing is, we're seeing unsustainable rates with Chinese property, and a very, very shaky, potentially, debt situation, especially as far as the shadow banking side of things are concerned. And to give it an illustration of how the Chinese government is saying one thing with one hand, but doing another thing with another hand, is actually stoking this bubble which Bloomberg has discussed. Basically, as of the first 5 months of 2018, investment in real estate is up 14%. Okay, and this is with so-called cooling by the government. And development loans are up 21%. This is in the first 5 months. This is in the first 5 months of 2018. So we have bubble territory, we have a high demand for the real estate, and what's even more alarming is that 1 in 5 properties in China is empty. And it's not being rented. And furthermore, these properties are actually deteriorating in condition, because a lot of these properties are bought to sell on or flip, as we say in the United States, and they're holding on to them basically as an investment. And this because if you've got 1 in 5 properties that are owned, and it's like 40% of Chinese families own more than one property, sometimes 2 or 3. What happens when the bottom falls out of the market? There's a panic to sell. Well, if 1 in 5 properties are empty, that's a spiral down that's going to take decades, possibly, with a declining population because of the demographics of the one child policy. to put right. So there's major problems going forward in China at the moment. So if we actually look at it, we look at the politics, and we're seeing that, we're seeing if there's been an increase in household debt to fund this side of things. This money's going to go to, as we say, money heaven. It's going to disappear, and that's not going to make a population very happy. And the Chinese leaders are very aware of this. And if you think behind the scenes, why have the Chinese allowed one person to be the supreme leader who has more power than Mao Zedong, who, whether you like it or not, was responsible for over 50 million deaths between the late 50s and mid 60s with the Cultural Revolution? Maybe they know something in the Communist Party that we don't know, so you have to be very aware. So let's have a brief summary of this. To me, and I've shown with research and with a lot of the other institutions that are now starting to sing that there's problems in the coal mine, what we're seeing is that this is the result of a credit situation, a debt situation that is exponentially potentially gone out of control. Things that rise exponentially always fall drastically. There's very, very rarely any instances in history that it's otherwise, and if that's being the case, why should China be an exception? What we have in China is a schizophrenic, bipolar economy. So we have a super inefficient state sector with the state-owned enterprises that gobbles up the capital that could go to build the Chinese economy for the future, because they genuinely, what they want to do is, if only 20% of the economy, if the sector that they need to grow to create a consumer economy is starved of capital, they're not going to be able to create a consumer economy to divert themselves away from government investment-driven GDP growth. It's not going to happen. So if you starve these companies of money, then they're not going to grow. They're not going to be able to compete. The money's all just going to get literally, as I say, gobbled up by the SOEs. So there's a major credit starvation that's going on, and it's going to continue on until something breaks. And when this breaks, it's going to have a domino effect, and it's more likely to break, as was said in the S&P report, in the opaque sector of the shadow banking system, where when it's like small dominoes, a small domino falls, it gathers momentum, larger dominoes fall, and then soon you have widespread contagion and panic. I mean, unfortunately, if you look at what happened towards the last quarter of last year, as the Shanghai Composite went down, it was pure, absolute panic with traders, etc. I can see the same panic happening with property. And yes, I know there are people watching this saying, property is never going to go down in China, there's such huge demand. Look, they said that between 2005 and 2007 in the United States and Europe, and look what happened. Properties savagely went down, and some of those properties have never come up. So that's not to say that it's that China's immune from this. So a property sector that has grown in debt, a property sector that's grown exponentially, and the debt associated with it exponentially, is a recipe for disaster going forward. So what I want to do now is go to the next video, where I'm going to synthesize all the relevant analyses that have done for the United States, China, and for the European Union going forward, because this is they're all going to behave differently, and they're all going to affect the global economy differently, but they're all going to be part of the mess that the global economy is going to suffer. So I look forward to seeing you in the next video. Thank you, and bye.